Source documents and special journals. Okay, in this chapter we're going to state and explain the uses of source documents, identify and explain the contents of source documents, differentiate between cash and credit transactions, extract information from source documents for bookkeeping purposes. We're also going to define what journals are. We're also going to learn how to use source documents for the preparation of appropriate books of original entry, and also how to enter correctly the information from source documents into books of original entry. Now, the first thing we're going to look at is what exactly are transactions. So transactions mean the transfer of goods and services from one person to another. So when goods and services are transferred from one person to another, cash usually follows. So for a transaction to be complete, goods and services must be transferred from one person to another. The cash may not follow immediately, but if the cash does not follow immediately, then there must be an intent for the cash to be paid later, and for such we call them credit transactions. But if the cash is paid immediately, that will be cash transaction. Okay, cash transaction. Now, whenever we have such transactions, the businesses and also the person receiving the goods and services always has something to use as an evidence to prove that a transaction has taken place. The most common we know are receipts. Once you pay your school fees, you either get a teller from the bank or receipt from the school stating that your school fees has been paid. So those are source documents, and the bookkeeper keeps records of these transactions on source documents, and examples of these source documents are: 1. A purchase order, 2. An invoice, 3. A debit note, 4. A credit note, 5. Cash register, 6. Tape checks, and 7. Receipts. Okay, so these are also called, they are also known as the books of original entry. Once a transaction takes place, they are recorded here first, and after which they are now transferred into another book from where necessary deductions and calculations are made. Okay, so once you buy something from the market or from a dealer, the dealer issues a receipt, or it could be an invoice for the total amount to be paid. So the dealer keeps also a copy. Now that copy is known as a source document. Later in the business, maybe by the end of the month, if you want to prepare his account statements, the source documents are now brought together, and all the transactions written on the source documents are now transferred into another book. Everything. So from this source document, you have 20,000 naira here. To now be transferred 20,000 naira. Another one, you have 15,000 naira. You add everything 15,000 naira, and now use it to calculate or know the statements of the business. Okay. So now we're going to look at the various types of source documents. Now the first one we talked about is a purchase order. So an order may be mailed in the form of a letter, or may be prepared on a specially printed form, which is usually issued by the supplier. Okay, it is a document which describes the goods to be bought, the quantity, the delivery dates to the purchaser, the unit price of the items, and the address of the delivery, if in case it is different from the purchaser's address. Okay, so a purchase order is just an order to state that a purchase should be made sometime in the future. So it states clearly the biodata of the person to make the purchase. By that, like I explained before, should have the address of the person, the name of the buyer, the quantity he wants to buy, and the delivery dates. So it's more like just an order, but no purchase has been made at the moment. Now the next one is an invoice. So an invoice is a business document which a seller of a product makes out whenever he sells goods to a customer. It contains usually the following information: the name and address of the buyer, that's very important, the date of sale, the description of the goods, and the terms on which the goods are sold. Okay, so an invoice, whenever a seller of a product makes out or has taken a decision on what to sell to a customer, everything, an invoice is drafted. Now, a debit note, on the other hand, it's very much like the invoice. It is a document that is written out by the seller whenever the buyer has been undercharged on the invoice. Okay, now let's say I buy something of 100 naira, but on the receipt I'm giving, it's the person who wrote the receipt mistakenly wrote 50 naira. Now I come back complaining that, sorry, this is supposed to be 100 naira, not 50 naira. So instead of issuing another receipt, what businesses normally do is to issue a debit note. Now the debit note now contain extra 50 naira, balancing this up, making this up to 100. Okay, so for such mistakes, a debit note is issued to correct the mistakes. Now a credit note, on the other hand, does the opposite of a debit note. Okay, so we have credit notes, and this time is when I'm overcharged. I buy something of 100 naira and the receipt shows 200 naira. So a credit note will be issued to correct this mistake, that no, it's supposed to be 100 naira. So now credit notes and debit notes, they help more the dealer. So when he's balancing his accounts, because he already has a receipt, a cash receipt, so showing 200 naira, he or she will now refer to the credit notes to now balance up that no, this is not supposed to be 200 naira, it's instead 100 naira. Now on the other hand, the cash register, you may not readily see this because it's gradually phasing out for computers, and also tape, and also some other machines used for recording transactions. Computers now do better jobs. Okay, but initially cash registers, there are machines that you punch in the transactions made and it prints out the cash receipt for the buyer. So the cash register is an automated machine. It keeps all the records automatically and prints out the cash receipt for the buyer. But now we have machines that can do that better. Now a check is a written order. Checks are very common. It's a written order from an account holder to a bank to pay a specified sum of money to the person whose name is written on the check. So I'm sure we must have seen checks at some point or the other. So I have an account with GT Bank. I use the GT Bank, my GT Bank current account check, write someone's name behind, pay some amount to bearer, and the bearer has to go with an ID card to clear the check from the bank. Okay, then the next one is a receipt. A receipt is a document issued to the buyer by the seller that is sum of money has been paid in respect of goods bought. So whenever I pay for goods, the buyer always issues a receipt to me to notify or to show that a specific amount of money has been received from me. Okay, so before now we explained cash and credit transactions, and we say that a cash transaction is one in which goods or services are paid for in cash. Very important, in cash. While a credit transaction is a transaction in which the payment is delayed until a later date. So that's a credit transaction. So that's the two types of transactions: a cash transaction and credit transaction. Okay, the next thing we'll look at is a journal. So a journal is the first book in which we record the transactions of a business. So initially the entries are made on the source documents, then later they're now transferred to journals. Now there are two types of journal. We have the general journal and also the general journal and the specific or special journals. Okay, so we have the general and the specific. So each record in the journal is called an entry. Okay, and journals are like diaries because it is in them that we record the day-to-day transactions of a business in the order in which they take place. A journal that is used to record one type of entry is called a special journal. And this journal can be kept to keep records, only records of purchases made by a company. However, a joint journal can be used for both sales and purchases, and this is known as a general journal. Okay, then when we look at the general journal, what do we expect to see on the general journal? We expect to see the dates of the transaction, the name of the account to be debited and the amount, then the names of the accounts to be credited and also the amount, and the description of the transaction. Now, why should we use a general journal? What are the importance? So we don't expect the bookkeeper to rely on the memory to remember every transaction. So that's why it's good to keep a general journal. It contains credit transactions, cash transactions, then complicated transactions which may be impossible to understand without being entered first in the journal are easier to understand because they have been passed through the general journal first. Now, the entry in the journal provides enough information for the person who takes over as to when the transactions occurred if the bookkeeper leaves the firm or company. Whenever someone else takes over, it's easy for the new person to go through the general journal and understand the details of the transactions. Now, the general journal also helps in the detection of errors, irregularities, and fraud, as it provides the entries and the details as necessary supporting evidence. Also, the risk of omitting a transaction or making one entry is also reduced. Okay. Now, special journals. Special journals, we have types of special journals. We have purchase journals. We have returned outward journal. We have number 3, sales journal. And number 4, returns inward journal. Okay, let's reorganize this. Better, we have purchase journal and sales journal. Then we have returns outward journal and returns inward journal. So we'll explain these journals and we'll now look at some examples. Okay. So the purchase journal is also called purchase day book. Also call it purchase day book. Or also call it the bought journal. Bought journal. Its purpose is to provide a record of all the goods a business has purchased for resale. Then the next one is the returns out. Let's look at the sales journal first. The sales journal. The sales journal is used to record all sales made as part of the trading operation of a business and is usually totaled up periodically and posted to the credit sales of the sales account. So the sales journal takes care of all the sales made in the business. Now, the returns outward journal, you have to take note of this word, outward. And when we talk of outward, or let's look at returns first. Whenever returns are made, returns could be made by the buyer. Let's say I have a business and I buy bad goods from someone. I, the owner of the business, I cannot return it to the person in Lagos I bought the business from. Now, people I sell to can also return some damaged goods to me, and those ones are said to come inwards because this is a business. These ones are inward and these are returns outward. So these returns, inward or outward, when you have returns outward, they are recorded in the returns outwards journal. Then returns inward, these are people that bought the goods from me and they return it back to me. The entries are made in the returns inward journal. Now click on Start Quiz and answer all the questions following.